All right, welcome to Thursday's SONAR update. Looking at the tender rejection indices, we are not seeing a whole lot of movement right now from the SONAR tender rejection index. Of course, the percentage of loads being rejected by a carrier to their shipper partners. 13.5%-ish is still a fairly high figure though. So we've seen this acceleration in decline in July that has now come to a halt. We primarily think that is a derivative of modal shifting that has occurred. We see a lot of shippers using intermodal, not just as moving storage, but also since that transit time is a little bit slower than trucks. It's July, August, not a lot of sense of urgency on that freight right now. So that seems to have really not made as much of an impact in the last couple of days. So what we're thinking is that this is potentially a bottom for the moment. The next seasonal flooring, or the next part of the, time of the year that we see rejection rates fall seasonally, is around October. We're heading into Labor Day, so these rejection rates actually will probably percolate a little bit. If you look at the last couple of years, it's almost a foregone conclusion. Rejection rates are going to increase. The question is, how much are they going to increase? And I think that it'll be a little bit stronger than we've seen in the last 3 years because there's not as much capacity, a little bit of a sense of urgency growth there as we approach Labor Day as well. But for the time being, 13.5%, still very tight market. Probably a little bit ahead of schedule in terms of moving towards that equilibrium point of 7-ish% that we think the market really starts to see a lot more maintenance in terms of the capacity stays online and rates don't inflate as much. So we've got a long ways to go, and we probably won't get there this year. So moving into the demand side of the equation, just to put this into perspective, we talk about this being a supply-led cycle shift. And it matters in the sense that supply moves much slower than demand. It's also a lot less volatile. It's really hard to go recruit drivers, buy trucks, make trucks, get the trailers, put them on the road. That takes a long time. With demand, it's any and all commodities that can grow overnight. Consumers can show up, start spending money as they want. So this supply side cycle is really well illustrated in the accepted volume index compared to the SONAR tender rejection index. Accepted volume index measures the number of accepted loads. So this is freight that carriers are accepting and moving. So guaranteed to move on the road. Then you have the rejection rate here that's going to tell you exactly how much of that is not being moving on the road. So we've got this accepted volume index. You can see over the last 5 years, 5 years or so, accepted volumes are actually down compared to where they were, but rejection rates are up. That's how we know that this is a supply-led cycle. Demand is not jumping higher. Yeah, it increased a little bit during the spring and summer months, but it really never broached this 2024 threshold. So we know a lot of capacity came offline over the last couple of years, especially last year. You see accepted volumes really floored out late last year, but rejection rates then increased. All that capacity came offline because the market could not bear it, couldn't fund the capacity that was staying there. We know this in all the earnings reports that came out last year that were abysmal. A lot of carriers losing money. So that's why we saw that capacity contraction. And now we're starting to see, and of course, all the regulatory pressure also helping exacerbate that and accelerate it. So it's going to take a minute, is the point of all this, for capacity to grow and for us to see a meaningful end to this cycle. It's probably going to happen really slowly unless demand side conditions fall down quickly. That is the one thing that happened this summer is we saw volumes, and if I could squeeze in on that last part there, volumes dropped pretty quickly or faster than seasonally expected because a lot of that freight went over to intermodal and moved on the rails. So let's hit the headlines here with the rates because that's what most people like to look at. Looking at spot rate indexes for dry van and white, refrigerated in the bluish teal, and flatbed in purple. You can see dry van is falling relatively quick. Flatbed is also starting to kind of edge lower, even though we're still staying high. But refrigerated, humming along as seasonally expected. So if you are operating in the refrigerated space, you definitely need to pay attention to this. Looking at a quick map of dry van rates, we've got a mixed bag. I know rates overall are going down, but look at all these blue markets. Blue means rates are going up more than they're going down. So there is some increasing activity, of course, probably due to Labor Day. We look at the refrigerated map, Well, a lot more blue on this map, looking at spot rates increasing through a large portion of the population outside of the southern tier here. And last but not least, the flatbed map, bit of a mixed bag as well, but still a good bit of blue.